Good morning, all. Today we'll be going to discuss Introduction to Accounting Part 3. In this part, we'll be discussing about the terms, basic accounting terms. Some of the basic accounting terms I have written down. Basic accounting terms. Now, very first, transactions. It is a financial happening entered into by two or more willing parties. Like for example, when you are buying goods from a supplier, so there are involvement of two parties. So one is supplier and another is business. So business is buying goods from the supplier. In return, the business is paying money to the supplier. So involvement of two or more willing parties. It affects a change in the asset, liability, or net worth account. Like for example, in case when we buy goods from the supplier, here the good comes in and the cash goes out. So there is a change in the asset of the firm. It is recorded first in journal and then posted into the ledger account. Example of transactions are sale of goods, purchase of goods, receipts from debtor, payment made to creditor, purchase or sale of fixed asset, payment of dividend, etc. Characteristics of a transaction. It is concerned with money or money's worth of goods or services. It arises out of the transfer or exchange of goods or services. It brings a change in the financial position, that is asset and liabilities of an entity. So for example, like if you have taken a loan from the bank, in that case your bank balance will increase, or at the same time your liability towards bank will also increase. It has dual aspects or sides. One is receiving debit and another is giving, that is credit of the benefit. Like for example, when you are buying goods from a supplier, in that case you are receiving the goods and in lieu of the goods you are giving money to the supplier. Transaction may be cash transaction and credit transaction. So it includes both the transaction, cash as well as credit. Next term is capital. Capital means the amount invested by the owner or the proprietor of the business. So it means the amount in terms of money or asset having money value which the proprietor has invested in the business and can claim from it. So it is a liability of the business towards the owner. So capital is a liability, internal liability of the firm. So there is a concept that is business entity concept. So business and owner both are separate identity. We are maintaining our books of account from the business point of view, not from the owner's point of view. That is why capital is called liability for the firm. Now, in case of sole proprietor, the amount invested by the owner is known as capital. When it comes to partnership firm, in that case the amount contributed by the partners is known as partners capital, and in case of a company form of organization, the amount contributed by the shareholder is known as share capital. Now, drawings. It is the amount of money or the value of goods which the proprietor or a partner takes for his domestic or personal use. So money withdrew for personal use is known as drawing. Money as well as the goods taken by the proprietor for his personal use is known as drawings. Drawing reduces the investment like capital of the owner, so it appears only in the account of sole proprietorship form and partnership forms. Next is your debtor. Debtor, a person or firm or company which owes amount to the enterprise on account of credit sale of goods or services. When sell of goods on credit, in that case, to whom we have sold goods on credit, that person is known as a debtor for the firm. So the amount due from his is a debt. The amount due from a person as per the books of the account is called a book debt. For example, goods sold to Ram rupees 10,000 on credit. So Ram is a debtor for the firm. Now, next, creditor, a person or firm to whom the enterprise owes amount on account of credit purchase of goods or services. Or in simple words, we can say the person to whom business purchase goods on credit is known as creditor. For example, goods purchased from Ram rupees 10,000 on credit. So Ram is a creditor for the firm. Next is assets. Assets are property or legal rights owned by an individual or business to which money value can be attached. In other words, anything which will enable the firm to get cash or a benefit in the future is an asset. For example, in simple words, we can say any property owned by a business firm is known as asset. Now, the benefit of asset will be received in future. Now, asset can be classified as fixed asset, current asset, tangible asset, intangible asset, and wasting asset. Fixed asset means we can say the benefit of these assets will be received in future. Like for example, for a manufacturing industry, plant, machinery, land, building, furniture, computer, these all comes under the fixed asset. Current assets are those assets which can be converted into liquid cash within a short period of time, let's say 12 months. Example of current assets are cash, bank, debtors, bills receivable, etc. Tangible assets are those assets which can be seen and touched. Intangible assets are those assets which cannot be seen and touched, but the benefit of these assets will be received by the firm, like for example, goodwill, patent, copyright, trademark, mining rights, computer software, franchisee, etc. Vesting assets are those assets from which the benefit will be received as and when we get the material extracted from the natural resources, for example, oil well, mines, etc. Liabilities. Liabilities means the amount which the business owed to outsiders. That is accepting the owners. So outsider means except owners. Owners liability is known as capital for the firm. So it can be expressed as liabilities is equals to total asset minus owners contribution, means capital. Liability can be classified as non-current liability and current liability. Non-current liability means which are to be paid after 12 months or after 1 year, and current liabilities are those liabilities which are to be paid within 12 months, means within the operating cycle of the business. Stock or inventory. Stock is the tangible property held by an enterprise for the purpose of sale in the ordinary course of business or purpose of using it in the production of goods mean for sell or the services to be rendered. Stock may be opening stock or closing stock. So there are two type of stock for the firm. Opening stock means the unsold stock of the previous year is known as opening stock, and unsold stock of the current year is known as closing stock of the. Now, profit. Profit is the surplus of revenue of a business over its cost. So in simple words, we can say profit is equals to sales minus cost of sales. So there are two kinds of profit. One is gross profit and another is net profit. So gross profit is the difference between sales revenue or the proceeds of goods sold or services rendered over its direct cost, and the gross profit is calculated by with the help of trading account. Net profit. Net profit is the profit made after allowing for all expenses. In case expenses are more than the revenue, it is a net loss. So after all indirect expenses, operating expenses, and after all non-operating expenses. So if the revenue is more than the expenses, in that case it will be a profit, and when the expenses are more than the revenue, then it is a net loss for the. Now loss, it is the excess of expenses over its related revenue which may arise from normal business activity. Now it decreases the owner's equity. Loss will decrease the owner's capital. It also refers to money or money's worth lost against which the enterprise receives no benefit. For example, cash or goods lost in theft. It also arises from events of non-occurring nature. For example, loss on sale of fixed. Expenses. An expense is the amount spent in order to produce and sell the goods and services which produce the revenue. Expenses is the cost of the use of things or services for the purpose of generating revenue. Expenses is that part of the expenditure which has been consumed during the current accounting period. So the benefit of the expenses will be received in the same accounting year. Example of expenses are salary, wages, rent, etc. Now, expenditure. An expenditure is the amount spent or liability incurred for the value received. An expenditure is a payment or a money sacrifice for a benefit received. Now, expenditure may be categorized into two parts. One is your capital expenditure and another is your revenue expenditure. Now, capital expenditure, it is the amount spent in purchasing assets which will give benefit over more than one accounting period. Like, for example, the benefit of the capital expenditures will be received for more than one accounting period. The expenses done on buying of fixed asset is known as capital expenditure. So it means expenditure incurred to acquire fixed asset or its improvement is known as capital expenditure. Capital expenditure is debited to particular asset account and they will appear at the asset side of the balance sheet. Revenue expenditure, it is the amount spent to purchase goods and services that are consumed during the accounting period, and it is to be shown in the debit side of the profit and loss account. So the benefit of the revenue expenditure will be received in the same accounting period. For example, purchase of goods as a revenue expenditure, salary paid, rent paid, etc. Revenue, it is the gross inflow of cash, receivables or other consideration arising in the ordinary course of business activities from the sale of goods, rendering of services and use by other of enterprise resources, like for example yielding interest, royalty and dividend. Like for example, if a company made an investment and the interest received on that investment, which is a revenue. Similarly, if a company made an investment in the shares of another company and the dividend received from that investment is a revenue for the firm. Now, example of revenue are receipts from sale of goods, rent, commission. Revenue differs from income. So income is equals to total revenue minus expenses. Sale of goods and services is revenue and cost of sales of goods and services is expenses. So revenue is an inflow of assets which results in an increase in the owner's equity. Income. Income is the profit earned during an accounting period. So in other words, the difference between the revenue and expenses is called income. Thank you everyone.